You can have the best strategy in the world, but without proper risk management, you are still just one bad trade away from losing everything. In today's video, I am going to show you exactly how to manage your risk like a pro and protect your capital so you can trade with confidence. Whenever you are a beginner or experienced, this is one skill every trader must master to stay profitable in long term. Stay with me until the end, because I'm also going to reveal a risk management tool that can instantly improve your trading result. Most traders don't even know about it. First, let's break down risk management actually means. In simple terms, it's the process of controlling how much you are willing to lose on any given trade. It's not about avoiding losses completely, but about minimizing those losses when they happen. Because, let's face it, every trader loses at some point. And why it is important? Here's the reality: even the best setup can fail, but with good risk management you can take a loss and still live to trade another day. It's the difference between a minor setback up and blowing up your entire account. Here on this graph you can see how your risk position influence on your trading account, how many money you can lose, how much money you can save if you choose a good risk ratio. Now let's talk about 1% rule. One of the golden rule of risk management is 1% rule. This means you should never risk more than 1% of your total trading account on a single trade. Why? Because it ensures that no single trade can destroy your account. Even if you have a few losing trades in a row, you are still in the game. Let's say you have 10,000 trading account, and if you follow the 1% rule, the maximum you should risk on any trade is $100. That's your safety net. But some traders push it to 2%, and that's fine if you're experienced, but as a beginner I highly recommend sticking to 1% until you build up consistently. Next up is the importance of using a stop loss on every trade. The stop loss automatically closes your position if the price moves against you beyond a certain point, protecting you from bigger losses. Let's say you are in long position and the price starts dropping. Instead of sitting there and hoping it turns around, your stop loss can automatically cut your losses at manageable level before things get worse. Never, I mean never, move your stop loss far away once you placed it. That's a recipe for disaster. Set it based on the technicals, not on emotions. Don't make this common mistake what wipes out so many accounts. The next tool for managing risk is understanding the risk-reward ratio. This is the ratio between how much you are risking on a trade and how much you expect to make. Ideally, you want this ratio to be at least 1 to 3, meaning for every $1 you risk, you should aim to make $3. Let's move to the examples of the real chart. So now we are on the real chart of Ethereum, 1 day time frame, and let's imagine what would happen if we opened a trade from this VVG. So let's mark it and use the backtest instrument. So on this means we are waiting for retesting of our VVG and we want to open a short deal. We took this tool from TradingView, what are very helpful, and it is the best way and the easiest way to control the risk. You place it like that with the conservative stop loss behind the VVG and hit the take profit and the capturing of liquidity, for example. And now how to use this instrument. At the beginning we need to click on that 2 times, and here you can see all the main settings on this table. Here you are entered trading amount what you are spent on every position. For example, here it has $20,000, and don't change that meanings if you are not trading forex. It's for forex meanings, and here it's always everything for forex. Don't use it if you are a crypto trader like me. And here you are placing your percent of risk, and if you want to make it correctly, always keep in mind your commission level and your exchange. So let's place 2% or 1% as I told you before, and let's place OK. So here we can see our risk reward ratio are gonna be 1 to 4. That means what if we lose this trade, we are gonna lose only $200, and if it will be profitable trade, we are gonna make $800. So here we can see on which price we need to open the deal. Here we can see what stop loss we need to place and what take profit we need to write down. And the most important thing is risk quantity. It's the meanings how much of this active you need to trade in this deal to correctly get $200 and to correctly lose $200 or get 800. Now we place this deal, place our stop loss, place our take profit, and now remember, we are not moving our stop loss if the price are close to liquidate us, like in this situation. If we are trading with gold head, so a deal are gonna look like that. It's a real-time trade. For example, here we get our take profit and fix our $800, and we don't lose everything. And if you are experienced trader, you always can fix your profit by pars, and this means 30% here, 60% here, for example 80% here, and 100 here, buyer take profit. So here we have a long position, what we are gonna to open. The price get a trade. Here it says like a short instrument, no other things here, not only this pause, but here we have $10,000. And here to get a risk ratio 1 to 5, we are gonna lose $100 and 1% risk can get 1,000. If the deal are gonna be successful. Here's the quantity what we need to buy to get this means, like I said before. And with this successful deal, we are gonna get $1,000. Always calculate your risk to reward ratio before entering the trade. If the numbers don't add up, it's not worth taking the trade. Now here's a bonus what I promised, risk management tool. And if you don't want to use a TradingView trading calculator, I prepared Excel file where you can write all your values on your trades and it's gonna give you correct calculations. So if you want it, follow my Telegram channel where I'm gonna drop it. So now let's talk about how to avoid getting off stop losses. For example, in this case, I open the deal with a stop loss above HVG because here the great amount of liquidity, and if we get the stop loss here, our trading strategy are gonna be wrong, and we don't need to open the trades against to the short positions because our deal wrong and it's not gonna work again, and the moving of the price are gonna be changed and every time, and we need to wait for another setup what we are gonna trade successfully, and place your take profits on the liquidity pools or on our point of interest, for example on the HVG or other blocks. It will help you to increase your percent of take profits and avoiding of stop losses. For example, in this situation, I place a stop loss behind the pool of liquidity. If the price take rate, we are not going to enter again in this deal because it's gonna be look like Ludo trading, and we not traders and we don't teach things like that, and we don't trade like that. And here I place our take profit in the previous high low, and it's the first point where the price have gonna grab as a liquidity until we get into with risk creation. So I highly recommend you to place all stop losses below the liquidity or below behind your stop losses or behind your point of interest, because it's the main zones for smart capital to improve. If your stop loss grabs the liquidity, you're make a long with your trade, and it is not a good trade. All the materials about stop losses and risk reward ratio and risk management you can see in my Telegram channel, so follow it and don't miss a new video and all the useful information. So, and if you want to protect your account and make smarter trades, check the link in the description for a free risk management tool that I personally use. So there you have it, everything you need to know about risk management and trading, from the 1% rule to using stop losses to reward ratio and proper position sizing. If you found this video helpful, hit the like button, subscribe for more trading tips, and make sure to the ring bell so you don't miss out the next video where I'll cover advanced trading strategies what can you start using right away. If you're serious about protecting your capital and growing your trading account, risk management isn't optional, it's a must. Comment below if you are even blow up and account due to poor risk management, and let's make sure it doesn't happen again. See you all in the next one.